Welcome to Japan Market Brief, the daily English audio update on what moved Japan's markets and what matters next. April 6th looked reasonably firm for Japanese equities, but the deeper story was not about simple optimism. The Nikkei 225 rose 1.42% to 53,879.99. That sounds constructive. But underneath the index move, the market was dealing with a new surge in energy and funding pressure. WTI crude briefly traded in the $115 range. Japan's 10-year government bond yield touched 2.41%, another high not seen in roughly 27 years. And several business headlines showed that the impact of fuel prices was spreading into electricity contracts, freight, and airline pricing. That combination explains why today's market should be read carefully. The Nikkei was stronger, but it was not because the macro backdrop had become easy. Instead, the index managed to rise, while the underlying cost environment grew more difficult. This matters because it tells us the market is becoming more selective. Investors may still buy some cyclical or oversold names, but they are doing it while a harsher cost structure is building in the background. Dollar yen stayed near 159.56. That is not a new shock level by itself, but it means the currency is still offering very limited relief. So the market faced high oil, high long-term yields, and still uncomfortable foreign exchange at the same time. The key macro signal today did not come from a new dramatic Bank of Japan message. It came from the bond market and from the way companies are responding to costs. When the long end of the JGB curve pushes this high, investors have to assume that tighter funding conditions will matter more for valuations, financing, and risk appetite. The important point is that energy inflation is no longer staying isolated inside commodity screens. It is showing up in financing conditions and in how businesses are thinking about contracts and pass-through. Today's stock to watch is Skymark. NHK reported that the airline is considering introducing domestic fuel surcharges from next spring. That may seem like a narrow industry story, but it is one of the clearest examples of how higher oil prices move into everyday business models. For airlines, the question is not only whether fuel costs rise, it is whether they can pass those costs on without damaging demand too severely. That makes Skymark useful as a read on pricing power under fuel stress. It also broadens the market's energy narrative. Recent sessions have focused on oil producers, materials, and shipping logistics. Skymark moves the story one step further downstream. It shows how sustained fuel pressure can reach the customer-facing end of the economy. That is why the stock matters even if the company itself is not one of Japan's largest market drivers. It represents a clear transmission channel from geopolitics and oil into consumer pricing and margin management. The next session will depend on whether the market can keep absorbing that cost pressure. Watch three things. First, whether crude remains around the $115 area or starts easing. Second, whether Japan's long-term yield keeps climbing above today's already elevated levels. Third, whether more companies begin openly discussing surcharges, contract suspensions, or supply prioritization. If those signs spread, Japan's market may continue to look stable at the headline level while becoming much more demanding beneath the surface. That is all for today's Japan Market Brief. Thanks for listening.